Nobody voted for it. Nobody signed it into law. There's no form to fill out, no line on your paycheck where it shows up. But every year, quietly and without apology, it takes more from the people who can least afford it, and almost nothing from the people who barely notice it exists. It's not income tax. It's not sales tax. It doesn't have a name most people use in conversation. But it is, by any honest definition, a tax. And it might be the most perfectly designed one in history. Let's start with two people. One makes $40,000 a year. She keeps most of her money in a checking account because rent is due every month, the car needs gas, and there's never quite enough left over to think about investing. Her money sits in cash. It has to. The other makes $400,000 a year. His savings are spread across index funds, real estate, and a brokerage account his financial advisor manages. He holds very little actual cash because he doesn't need to. His money is always working. Now imagine something quietly erodes the purchasing power of every dollar in circulation by 7% in a single year. That happened in 2022. It was called inflation. And what it actually did to these two people was completely different, even though the number was the same for both of them. Here's the mechanism, and it's worth understanding slowly. Inflation means prices rise. A dollar today buys less than a dollar did last year. That part most people know. What most people don't think through is what you have to own for inflation to hurt you versus help you. If your wealth is stored in cash, in a savings account earning 1% while inflation runs at 7%, you are losing 6% of your purchasing power every year. Silently. Automatically. Without a single transaction. The number in your account stays the same. The amount of life that number can buy gets smaller. But if your wealth is stored in assets, in property, in stocks, in commodities, inflation often does the opposite. It pushes the nominal value of those assets up. The house you bought doesn't just hold its value during inflation. Frequently, it gains. The stock portfolio doesn't just survive. In many inflationary environments, it climbs because companies can raise prices too, and equity is a claim on real things, not on a fixed number. So inflation functions in practice as a tax on holding cash. And who holds cash? Mostly people who can't afford not to. This is where the math gets uncomfortable. The bottom 40% of American households hold roughly 3% of the country's total financial assets. The top 10% hold over 80%. Which means that when inflation runs hot, the people with the least absorb the most damage in real terms, not because they're losing more dollars but because the dollars they have are almost all they have. A 6% real loss on $10,000 in savings is painful. A 6% real loss on $200,000 in a brokerage account that also gained 12% in equities is basically invisible. And here's the irony that rarely makes it into the conversation. Inflation is often produced, at least in part, by policies designed to stimulate growth and help working people. Stimulus payments, low interest rates, government spending, these are tools deployed during recessions when ordinary people are struggling. The side effect of those tools when they run too long or too hot is inflation, which then hits those same ordinary people hardest. The cure and the poison come from the same bottle. They just land differently depending on what you own. There's another layer that almost never gets discussed. Wealthy households don't just benefit from owning assets during inflation. They also have access to cheap debt. When inflation is high and interest rates eventually rise to fight it, the people who borrowed money at fixed low rates before the rise, people who own mortgages on real estate for instance, are actually repaying those loans with dollars that are worth less than the dollars they originally borrowed. Inflation quietly reduces the real burden of debt. Who has access to large, long-term, fixed-rate debt backed by appreciating assets? Largely, people who already have wealth. Because that's how lending works. You get the best terms when you need the money least. The person renting an apartment doesn't get to borrow against an asset. The person with a 3% fixed mortgage on a house that's gone up in value is, in a very real sense, being paid by inflation. Not because they did anything clever. Just because of what they already owned when inflation arrived. None of this is a conspiracy. Nobody designed the system in a boardroom to punish the poor. It emerged from the architecture of how money, assets, and credit actually work, and it functions the way it does whether or not anyone intends it to. That's almost what makes it worth paying attention to. The most consequential economic forces often aren't the ones with the obvious agendas. They're the ones that operate through structural logic, through the difference between owning a thing and holding a number, through access and inertia and timing. Politicians debate tax brackets and capital gains rates and inheritance laws. Those things matter. But inflation moves in the background, every year redistributing purchasing power from the bottom up. And it does it without a vote, without a press conference, and without most people ever quite naming what's happening to them. The question isn't whether this is fair. Fairness isn't really how economic systems are designed. The question is whether people who are losing the most from it even know it's happening, and what changes when they do.